I'm Adrian Manns, live from the Money Show in Seattle, Washington. I'm here with Bob Lang of explosiveoptions.net. And we're going to talk about some options strategies here at these all-time highs that we're hitting in the markets. I'm a stock trader. I trade intraday, and I can tell you for the last 18 months I've been mostly short.
Yeah.
So usually that's a pretty good barometer to us of what's coming, but how are you dealing with it?
Well, as an options trader, you always have to be aware of volatility. And when volatility is on the rise, that means you're going to have some big movements in the markets, up and down, right? But as humans, we generally are risk averse, right? We don't like big giant moves to the downside. You don't mind big moves to the upside if you're long your portfolio, right? But in order for us to deal with the big moves to the downside, we have to have protection. And the best way to have some protection is to buy some puts. And index puts, very simple, very plain vanilla type of way of doing it. Shorting stocks, like you talk about, like you do, is also a very effective way of doing it too. But for somebody who's long portfolios, maybe you want to put out some minimum amount of cash to protect themselves in their portfolio. Index puts are the best way to go.
How about you doing anything with spreads or calendar spreads? Or?
Spreads are good. Calendar spreads are excellent when volatility is elevated but not moving around very much. So we have a current volatility index that's sitting around 16%. Right. A little bit more elevated than it was a couple of years ago. Remember back in 17, we had some single-digit volatility of some amazing days there, right? I mean, it paid you to buy volatility because realized volatility was low, implied volatility was equally as low, and all you needed was some day when the markets were getting blasted to really make that insurance pay off, right? And you had long stocks, but you wanted to protect those gains that you might have had. So, and, that was 17 was a year. Don't forget, the S&P 500 was up every single month that whole calendar year. First time ever in history, the S&P 500 was up every single month. But in order to protect your gains, protect your portfolios, you bought some insurance. It was cheap. Now it's 16%. It's somewhat elevated. 50-70% elevated more than it was back then. It's a little bit more expensive, but it still makes more sense to buy protection.
Are you trading volatility directly?
Against my long portfolios, yes. Trading volatility directly. I'm buying index puts like the spiders, the Qs, the DIA. Russell 2000 has been fairly weak. It's been really probably the weakest of all the indices. You can just buy plain vanilla strategy, just buy some at-the-money puts. It's cheap, it's not expensive. When volatility is starting to rise, remember like we had back in December, remember when the VIX went up from about 16 or 17 all the way up to 36? Put protection got very expensive. It was very expensive to protect portfolios because the market was expecting huge moves up and down, right? Up, again, nobody cares about when the market's going up there. Everybody's happy, they're making a lot of money in a big way. But if we get equal moves to the downside, it prevents a lot of pain, a lot of anger, a lot of frustration, and people are losing money. So if you protect yourself with portfolio insurance via puts, when volatility is somewhat low, you can protect yourself from the downside.
So if people want to follow your thoughts on these things, explosiveoptions.net?
That's where I'm at, explosiveoptions.net.
All right, so for the Money Show, I'm here with Bob Lang, and I'm Adrian Manns.